So with this, let's set path for the fourth session today. When the wind of the change blows, some build walls while others build windmills. Yes, this is true in the sense when we talk about cryptocurrencies, aka virtual digital assets. So I am bringing on Mr. Raghav Bajaj to talk about the hottest topic after the budget, virtual digital asset. Mr. Raghav Bajaj is the principal associate in the direct tax practice group of Khitan and Company. His specialization is in various matters of direct tax, transfer pricing, digital taxation, tax dispute resolution, and so on. He focused extensively on cryptocurrencies and the underlying blockchain technology also. So it's a great pleasure to have you on board and a hearty welcome to you, sir. Welcome, sir.
Thank you, Ridhima, for the wonderful introduction. If the slides can be put up on the screen, I think Sumit knows.
All yours.
In the meantime, respected seniors, fellow speakers, professional colleagues present in the webinar, a very good afternoon to everyone. I'm sure everyone has taken note that the Union Budget 2022 has been introduced as a blueprint to steer the Indian economy and foster growth for the next few decades. Honorable Finance Minister has proposed significant proposals to give a holistic fillip to infrastructure development, capital expenditure, and a clear focus towards digital economy and fintech. One more point that was noteworthy is the fact that, perhaps for the first time, aspects like mental health found mention in the Union Budget of India. Now, with this backdrop, let me now focus on the topics which have been allocated to me. The first one being the most awaited and the much talked about, the special tax regime for taxation of virtual digital assets, or VDAs. As the Honorable FM noted during her speech, there has been a phenomenal increase in transactions in virtual digital assets, and the magnitude and frequency of these transactions have made it imperative to provide for a specific tax regime. Now, this acknowledgement speaks volumes about the substantial increase in Indian crypto investments and the consequent need to have at least some guidance in the Income Tax Act as to its taxability. Because in the past few years, what has happened, there has been a lot of discussion going on as to what is the correct manner of taxability of cryptocurrency gains. I'm sure everyone here has at least some background about the constant debates that have been going on around, the legal versus illegal nature of cryptos, the virtual digital assets, and what should be the most appropriate characterization for this asset class. Now, since those debates have not yet been put to rest, the proposal to introduce a tax regime for VDAs has ignited many speculations in the past 2-3 days. Now, broadly speaking, Finance Bill 2022 has proposed 3 steps in relation to VDA taxation. First is the proposal to introduce a separate regime for taxing the gains arising to a taxpayer from transfer of VDAs. Second is the proposal to introduce a recipient level tax for receipt of gifts of VDAs. And the third proposal deals with a new TDS levy for payments made in relation to VDAs, that is virtual digital assets. Now, since this aspect of the finance bill has been talked about a lot in the past few days, and there are some interesting issues which have emerged out of the same, let us take each of these 3 buckets one by one and do a detailed analysis of these provisions. If you can move to the next slides, the evolving approach towards virtual digital assets. One more, next slide, please. Yes. So let me just give you a quick snapshot of the evolution of cryptocurrency ecosystem in India, because it is very important that we understand this backdrop so that we are able to appreciate the budgetary proposals in relation to VDAs. So the timeline of crypto ecosystem in India can be broken down into 3 broad categories. The first phase being the years 2013 to 2017, when India adopted a cautious approach. And this can be seen clearly from the press releases of RBI in those years, in which it cautioned the general public about cryptocurrencies and highlighted several risks such as fraud, volatility, potential usage in illicit activities, no underlying asset. Then in 2017, the government constituted an interministerial committee, an IMC, which had representation from different ministries of the government. And the objective of this committee was to study various issues pertaining to virtual currencies. The second phase would be the years 2018 to 2019, when India adopted a conservatory approach, or rather a crackdown approach, as some people like to call it. Now, what happened in the budget speech of 2018? The then finance minister said that the government does not consider cryptocurrencies to be legal tender, and that it will take all measures to eliminate the use of these crypto assets in financing illegitimate activities or as part of the payment system. Then came the famous April 2018 circular by RBI, by which the RBI directed all its regulated entities, that is basically banks, to stop providing any services to or facilitating any entity or person who was dealing with cryptocurrencies. Now, this was a major setback for the cryptocurrency ecosystem in India. Then in 2019, the IMC, that is the Interministerial Committee, issued its report where it recommended that all private cryptocurrencies should be banned in India. Of course, this was another major setback for this budding Indian cryptocurrency ecosystem. And the third phase would be the years 2020 and onwards, which saw some important positive developments. Because what happened firstly in 2020, the Honorable Supreme Court set aside the 2018 circular. Of course, this was seen as a watershed moment for the crypto ecosystem in our country. So what happened is that even though the Supreme Court acknowledged that RBI had the power to regulate cryptocurrencies, it said that the 2018 circular was an arbitrary and a disproportionate measure, because the RBI had no concrete data on whether cryptos had any adverse implications on the entities which were regulated by it. Then in 2021, last year, another bill related to cryptocurrency was listed for being introduced in the budget session last year, but the same got deferred. Then everyone expected that it will be introduced in the monsoon session or the winter session, but as we stand today, the revised bill has not yet been introduced. And perhaps this constant delay has led to continued speculation as to what will be government's stand in relation to virtual assets like these. And in all this while, one common question was, how will crypto gains be taxed? What will be the tax implications in case of gifts of cryptos, etc., etc.? So now let us decode the budget proposals that have come in this regard in light of this backdrop of over past around 9 to 10 years that has been happening in India in relation to crypto assets. Next slide, please. The first point that one must take note of is the wide manner in which VDAs have been defined for the purpose of Income Tax Act. As you can see on your screen, the definition talks about tokens generated through cryptographic means, which can provide a digital representation of value or function as a store of value or unit of account. Then it contains a clause on non-fungible tokens, which will be notified by the government, popularly called as NFTs. And then it contains enabling clauses to empower the government to either notify additional assets or exclude any particular digital asset from the ambit of this definition. Next slide, please. In terms of taxing proposals, the first is to introduce a separate regime for taxing the gains arising to a taxpayer from transfer of VDAs. For this purpose, a new section 115 BBH is proposed to be introduced in Income Tax Act. And what does this section provide? It provides that the gains arising from transfer of VDAs will be taxable at a flat rate of 30%. Interestingly, the section does not make any reference to resident taxpayers or non-resident taxpayers. Hence, what appears, at least for the time being, is that crypto gains arising to non-residents also will be taxable as per this regime, of course subject to satisfaction of the situs rule or source rule test with India. As I said earlier, VDAs have been defined very broadly by way of the new section 2 clause 47A to section 2 to cover, among other things, information, code, number or token generated through cryptographic means or otherwise to be notified, NFTs or other to be notified digital assets. So as you can see, the delegation of power is very wide by virtue of this budget proposal. From an income computation perspective, it is proposed that except for the cost incurred in acquiring the VDAs, no deduction of expenses or set off of any loss will be available against the income arising from transfer of VDAs. What is also provided that any losses arising on transfer of VDAs will not be available to be set off against any other income. Now, at the outset, what must be appreciated is that finally, there is some guidance in the income tax law regarding taxability of crypto gains. Now, whether this special tax rate of 30% is on the higher side or lower side is a matter of separate debate. But at least there is some guidance now in the income tax law itself. Next slide, please. The second proposal is about the introduction of a recipient level tax for receipt of gifts of VDAs. For this purpose, an amendment has been proposed in section 56(2)(10) of the Income Tax Act to expand the definition of property. So what this means is that the receipt of VDAs by a person for nil or inadequate consideration will be taxable in the hands of the recipient unless it falls within the list of specified exceptions, such as gifts from relatives. You would note that for the purpose of section 56(2)(10), the expression property used to take meaning from the explanation to section 56(2)(7). Now, interestingly, VDAs have not been added to that list. Rather, VDAs have been added as a separate asset class in the definition clause in section 56(2)(10) itself. Next slide, please. And the third proposal talks about a new TDS levy for payments made in relation to VDAs in order to capture the transaction details. Again, for this purpose, a new section is proposed to be introduced, that is section 194S. As per this section, persons making payments to Indian residents towards the transfer of a VDA will be required to deduct tax at the rate of 1%. And to ensure that unnecessary burden is not created in respect of small transactions or on small taxpayers, it is proposed that this TDS requirement will apply only if the consideration exceeds 10,000 rupees during a financial year. For individuals and HUFs whose turnover or gross receipts are below a specified limit, a higher monetary threshold of 50,000 rupees is prescribed. So that's the good part, that there is going to be a TDS levy, but yes, for small taxpayers or for transactions of small amounts, the TDS requirement will not be there. Now, once tax is deducted under this section, the law provides that any other provision requiring tax withholding or tax collection will not be attracted. If the consideration payable is wholly or partly non-cash, so for example, if the consideration is in kind, then the payer will have to ensure that tax is paid in respect of such transaction before releasing the consideration. What is also proposed is that if this new provision as well as section 194O, that is the TDS for e-commerce operators, both are applicable to a transaction, then this new provision, that is section 194S, will prevail over 194O. So this was all about the amendments which have been proposed in Income Tax Act in relation to VDAs. Several issues, challenges, questions have arisen in this regard. So now let us do a deep dive analysis of those questions, of those issues, of those challenges which have arisen. Next slide, please. So the first issue that has arisen is on account of the wide manner in which VDAs have been defined. We saw the definition earlier, and now given the wide definition, what will have to be examined is whether assets or benefits like digital gift cards, loyalty or cashback points on cards, and other similar assets, whether those assets could be covered here. Now, this is because such assets are also a store of value and can be stored electronically. This issue is important because the expression that has been used to define this asset class is virtual digital asset, which is a very wide term to cover all types of digital assets. One can argue that, while it was expected that the government will bring about a taxation regime for cryptocurrencies, but whether the choice of such a wide term is intentional to cover other assets like digital gift cards, loyalty cards, etc., or that is just an interpretational doubt, I think that should be clear in the next few weeks when the bill is passing through the parliament. Of course, the good part is that there is an enabling clause in the definition section empowering the government to exclude any digital asset from the definition of VDS. But we must be mindful that at the same time, the definition section has provided some teeth also to the government by authorizing it to notify additional digital assets for the purpose of VDS. Non-fungible tokens, that is NFTs, which will be covered by this definition clause, will also be notified. The next set of issues come from the manner in which the proposed section 115 BBH is worded. So what has happened is that, while it is clear that no deduction in respect of any expenditure or allowance shall be allowed while computing income except the cost of acquisition, and that the loss from transfer of VDA cannot be set off against any other income. So these 2 points are clear. But what is still not clear 100% is this, that can the loss arising on transfer of one VDA be set off against gains arising from some other VDAs? Basically, the question is this 30% tax leviable on the gross gains earned by a taxpayer, or is it leviable on the net gains earned? Let me give you an example. Suppose a taxpayer earns gains of 50 rupees on transfer of one VDA and incurs a loss of 40 rupees on transfer of another VDA. Would the tax be payable on 50 rupees or only the differential amount of 10 rupees? Now, let me point out that, this is an important point, because the high volatility in prices of this asset class makes it very common for taxpayers to incur losses also on their investments. If we hear some webinars wherein some officials have been speaking, it appears that the government is not keen to allow this set off and that they want tax on a gross basis. But we must be mindful and we must be watchful of what the fine print of the final version of Finance Act comes, because this will be an interesting aspect and there has been a lot of debate which is going around this topic. Interestingly, in the budget proposal, unlike Section 50C or Section 50CA, there is no mention of a deemed fair value taxation in relation to virtual digital assets. So that's a good point. Next slide, please. Another important point to note is that what is allowed as a permissible deduction is only the cost of acquisition. Now, technically speaking, cost is a wider term than purchase price. And hence, crypto miners may want to take an argument that, in case of tokens generated by mining process, costs like network cost, electricity cost should also form part of their cost of acquisition. Whether this claim will be allowed or whether it will lead to a prolonged litigation battle will be known only in future. But one should keep a close watch on whether there is any update in this regard during the passage of the finance bill in the parliament. With respect to cost of acquisition, there is one more point that one should take note of. The budget proposal has not introduced VDAs as a separate class of capital asset. Now, what this means is that regardless of the period of holding, the rate of tax will be flat 30%. This would mean that even if a person is holding a virtual digital asset for a long time, the gains arising on transfer will be taxed at a flat rate of 30%. The next issue is about the nature of transactions that are covered under Section 115 BBH. So this section talks only about the income from transfer of VDAs. This would mean transfer of a VDA from one person to another person. That is to say that the VDA should be in existence prior to the transfer event. What happens if the VDA is coming into existence itself by virtue of a transaction between two persons, for example, a fresh issuance? Then that does not appear to be covered by this regime. Now, what this implies is that the generation of a new token, let's say by way of mining, will not trigger a taxable event under Section 115 BBH. This aspect about prescribing the first taxable event actually could give a boost to miners, because if crypto mining would have been made the first taxable event, then it would have disincentivized crypto miners from undertaking the mining activity. Further, what this also means is that if fresh tokens are issued to a celebrity or any other person, then that will not be subject to section 115 BBH tax, because it seeks to capture gains arising from transfer activity only. Of course, for all these points, the recipient level tax section 56 will have to be evaluated. Another point that has been coming up for discussion is that what will happen if an employer issues fresh tokens to its employees? I think in that case, from employer's perspective, 115 BBH may not be applicable, because, as we discussed earlier, that section covers only the gains arising on transfer. However, from employees' perspective, what will be interesting is whether it will lead to salary taxation and thereby triggering TDS obligation for the employer, or whether it will just lead to section 56 tax in the hands of the recipient employee. Notably, the new section will apply for FY 2022-23 and onwards. That is, the transfers of VDAs which take place on or after 1st April 2022. What follows from this is that since the new regime is applicable from 1st April 22, for gains which are earned in the past, and the gains which taxpayers will earn from now till 31st March 2022, the manner of taxation has not been laid down. Of course, one may want to argue that this new regime implies that the government's view is that it wants a 30% share of gains made from transfer of VDAs, and hence for gains earned till 31st March 2022 also, taxpayers should pay 30% tax. But at the same time, taxpayers may also want to contend that for gains earned till 31st March 2022, the debate of business income versus capital gains will continue. Now, while from a rate perspective, this debate may not be too relevant, but what would be relevant is the manner of computation. Because in the absence of a clear-cut regime, taxpayers may want to claim deduction for not only the purchase price, but other incidental costs also. Similarly, in such a scenario, taxpayers may want to set off other losses from crypto gains and vice versa. So it will be interesting as to what will happen to losses incurred till 31st March 2022. In fact, because of this, there may be some taxpayers who just dispose of their crypto holdings before 31st March 2022 on the hope that they don't come under the new tax net. And at the same time, some taxpayers may want to hold cryptos after 1st April 2022, so that they are sure that when they sell their VDS, there is a clear-cut regime. The fact that there is no holding period benefit, etc., may also be a very important factor in this decision making. So all in all, very interesting times to come in the field of VDS. Next slide, please. In relation to section 56(2) tax, the first issue is that the memorandum does not make a mention of any valuation rules. From a section 56 tax perspective, valuation is perhaps the most important aspect, and in the absence of any specific valuation rules, there is lack of clarity on the manner of valuation of VDS for the purpose of this tax. So I think it is likely that the government may address this point in due course by amending Rule 11 UA. Another point to note is that when it comes to section 56 tax, the tax is levied on at the slab rate applicable in case of individuals and the corporate income tax rate applicable in case of companies. So for taxpayers not falling within the higher slabs, the impact of section 56 tax may still be lesser as compared to the flat rate of 30% under 115 BBH. Same analysis should apply for companies also who will opt for the concessional corporate income tax regime also. Next slide, please. In relation to the new TDS section, the first thing that must be noted is that it is applicable to payments to resident payees only. Now, in the case of payments to non-residents, no special withholding tax rate is prescribed, which would mean that the general principles of taxability subject to situs or source rules and consequent withholding would be relevant. From a compliance perspective, there may be certain practical challenges, such as payment of tax when consideration is in kind, and the availability of details regarding identity or tax residence of sellers, which may need to be closely evaluated. In case of platform models, where the identity of buyer and seller is not known to the other party, it will be interesting to see how compliance with this provision will be ensured. And hence, I think VDA platforms should also keep this provision on their radar to assess whether it will lead to any additional compliance costs on them. Uh, there is an interpretational issue also in relation to the exception provided to specified persons from the applicability of some other provisions of Income Tax Act, like the obligation to obtain TAN number. Perhaps those could be drafting related issues also, which may be taken care of in the final version of this law. Next slide, please. So what lies ahead in the sphere of VDAs and cryptocurrencies is the question that everyone is asking. As I said earlier, because of this separate tax regime for VDAs, speculations have reignited as to what is government's stand in relation to cryptos. Some people are interpreting this move as a positive step by the government and inferring from it that uh, the government is likely to take a pragmatic and practical approach when the cryptocurrency bill comes. On the other hand, some people are reading it as merely a taxing provision and that no views should be developed basis this taxing move. Government has clarified that for the time being, they have just created this taxing provision so that people who earn gains pay applicable tax thereon. And how it will be regulated or dealt from a legal or regulatory perspective would be dealt with in the cryptocurrency bill if and when it is introduced. So at least on the regulatory bit, we should wait and watch as the stakeholder consultation process is still on and the government is still taking points from the relevant stakeholders as to what can be the impact of any cryptocurrency bill. Separately, one more thing that we must be aware of is reporting and disclosure in income tax return forms. It is possible that when the ITR forms are released, there is some guidance or instructions on the manner of reporting disclosure also in relation to VDS. Next slide, please. The next proposal that I would like to discuss relates to the amendment that has been proposed to section 56(2)(10) in relation to ex gratia amounts provided for COVID-related treatment. So as we all know that a receipt of money in excess of 50,000 rupees from non-relatives is taxable as ordinary income in the hands of recipient, unless it falls within certain specified exceptions. Keeping in mind the unimaginable consequences of COVID-19, the finance bill has proposed to exempt the financial assistance received by an individual from an employer or any other person for expenses which are incurred towards the treatment of COVID-related illness of himself or herself or his family or the family. Further, the ex gratia amount received upon the death of a family member due to COVID-related illness is also proposed to be exempted. And there are two categories. So without any monetary limit, if the amount is received from the employer of the deceased person, and to the extent of 10 lakh rupees if it is received from any other person. And for this purpose, family would mean the same as defined in section 10 clause 5, as per which family means the spouse and the children of the individual, or the parents, brothers, sisters, that is the siblings of the individual, wholly or mainly dependent on the individual. Similar amendment has been proposed to section 17 also to exclude similar receipts from the ambit of the definition of perquisite. Actually, these amendments proposed are in line with the Finance Ministry's press statement of June 2021, where such tax reliefs were announced for the first time. Next slide, please. The next proposal that I would like to discuss is the amendment proposed to section 68 of Income Tax Act. Now, in terms of current provisions, section 68 provides that where any sum is found to be credited in the books of an assessee maintained for any financial year, and the assessee offers no explanation about the nature and source of such sum, or the explanation offered is not satisfactory in the opinion of the AO, then the sum so credited may be charged to income tax as the income of the assessee for that financial year. The important point is that income charged to tax under section 68 is taxed at a higher rate, that is at the rate of 60%, and no set off or deduction is allowed against such income. Broadly speaking, the taxpayer is required to substantiate the identity and credit worthiness of the person from whom money is received and the genuineness of the transaction itself. In common parlance, this is referred to as the ICG test, or the onus on a taxpayer to substantiate its source from where it received any money. Different details are furnished by taxpayers to meet this ICG test requirement, as you can see, for identity, creditworthiness, and genuineness. Next slide, please. Now, Finance Act 2012 had brought about an important amendment to this section, whereby it was provided that the nature and source of any sum, in the nature of share application money, share capital, share premium, or any such amount which is found credited in the books of a closely held company, that will be treated as explained only if the source of funds is explained in the hands of the shareholder also. And this was made applicable in case of monies received from resident shareholders only. Can you move to the next slide, please? Now, what this meant is that in case of share capital or similar amounts which were received by a closely held company from a resident shareholder, the recipient company had an additional onus to substantiate the genuineness of the source of funds in the hands of the shareholder also. In common parlance, this meant that the recipient company's onus extended to explaining the source of its source. From a practical perspective, this section was resorted to on many occasions by the department if there was a doubt about the legitimacy of any particular receipt in the hands of a taxpayer. Now, the amendment which was brought about in the year 2012 extended only to share capital, share application money, share premium, etc., as I said earlier. In other words, it did not apply to loans or borrowings which were received by a taxpayer. Now, despite this, in various matters, it was observed that wherever the authorities had a doubt about the authenticity or of any loan or borrowing, inquiries under this section were made and taxpayers were asked to explain the source of source, that is the source of funds in the hands of the lender. So if A borrowed money from B, then inquiries were there that, okay, what is the source in the hands of B also? Now, since this action was not permitted strictly within the four corners of the language of section 68, taxpayers challenged such actions and got decisions in their favor, wherein it was held that, in case of loan or borrowing, only the creditworthiness and identity of the creditor and the genuineness of the transaction for explaining the credit in the books of account is sufficient, and that this onus does not extend to explaining the source of funds in the hands of creditor. To put it otherwise, in case of loan or borrowings, taxpayers' onus did not extend to explain the source of their source. Now, this aspect of section 68 has been proposed to be amended by Finance Bill 2022, whereby a new proviso is to be added, requiring taxpayers to explain the source of funds credited in the books in the nature of loans and borrowings. Given that the unexplained credits are taxable at a higher rate under this section, and that too without any set off or deduction, I think it is a very important proposal because it creates an additional onus on the taxpayer to substantiate the genuineness of borrowings reflected in its books of accounts. Can we move to the last update, that is dividends received from foreign companies? So the last proposal that I would like to discuss is the amendment proposed to section 115 BBD of Income Tax Act. If we can move a few slides more, we can go there. Next, please. One more. Yes, next. So by way of background, please note that section 115 BBD was introduced in Income Tax Act by Finance Act 2011 with a view to provide incentive to Indian companies who had invested in businesses outside India. It provided for a lower rate of tax of 15% on the Indian companies which received dividend from a specified foreign company, that is a company in which the Indian company held at least 26% shares. The benefit was that this rate was to apply in place of normal tax rate of 30%. And this was in alignment to the DDT rate which was prescribed under the Income Tax Act at that time. As I said, this reduced tax rate was introduced in the law so that Indian companies are encouraged to bring offshore profits to India. And as you can see on your screen, the relevant extracts of the budget speech when this particular provision was introduced. the then finance minister actually made a statement that, I do hope these funds will now flow to India. Now we all know that after that, in the year 2020, dividend distribution tax itself was abolished to provide that dividend shall be taxed in the hands of the shareholder at applicable rates plus surcharge and cess. What this meant is that because of the presence of section 115 BBD, there was a disparity in the rate of tax levied between dividends received by an Indian company from other domestic companies as compared to the rate of tax leviable on dividends received from specified foreign companies. Next slide, please. Now, to ensure consistency with the prevailing dividend taxation regime and parity between domestic dividends and offshore dividends, it is proposed that dividends received by Indian companies from such specified foreign companies would be subject to applicable corporate tax rates, and that the concessional tax rate of 15%, which is currently applicable, would be done away with. This is a prospective amendment. Now, in terms of impact, while the rationale behind introduction of this provision is completely understandable, one wonders whether from a policy perspective, there would have been merit in allowing this section to operate for a few more years, so as to continue to incentivize Indian companies for bringing offshore dividends back to India. Because now what will happen is that if an Indian company receives dividend from a foreign company, then that dividend will also be taxed at the same corporate income tax rate applicable to dividend received from other domestic companies. Now, on one hand, it may appear, that as if the repatriation of offshore dividends to India is no longer lucrative, at least from income tax perspective. But at the same time, what it could also do is that it will ensure that Indian companies do not have a tax incentive to set up companies abroad. So it will be interesting to see how this amendment affects the flow of dividend from such foreign companies to their Indian corporate shareholders. So this was about the amendments in relation to amendment proposals in relation to taxation of virtual digital assets. Section 68, which is now requiring taxpayers to explain the source in relation to loans and borrowings. Section 115 BBD, which used to contain a concessional tax rate on dividends received by Indian companies from specified foreign companies. That rate has been withdrawn, and the exemption to ex gratia amounts received in relation to COVID-19 related illnesses.
Thank you so much, sir. Again, can we have some questions put forward?
Sure.
Okay. So first we come with this question is from Janender. They says there are utility and governance tokens which do not necessarily serve as representation of value or a unit of account, such as AAVE and Uniswap. Some altcoins are also among them. How will these be taxed? Will the added provision apply on their transfer?
So as I said earlier, the definition is very wide.
Right.
There is one clause in which government can notify other virtual digital assets, and it can then, as I said earlier, there is a clause in which it can exclude certain other assets. As of now, the definition clause, of course, there is some drafting issues which I found, in the form of a comma or a semicolon, which is inserted there in the end of the provision. Okay. But right now, what is to be seen is whether it serves as a value, it functions as a store of value of account. If it does not, if a token does not function or fulfill or meet any of those tests or requirements, then it will not form part of the virtual digital assets.
Okay.
So again, the functions of that particular token will have to be seen.
Correct. And another one coming is, can VDA provisions impact film industry?
I mean, instead of industry, I'll say anyone who is bringing people or any non-fungible tokens which are coming out, because a lot of people have come out with their non-fungible tokens. So not just one particular industry, but anywhere if a non-fungible token is coming out, they will have to be watchful of this particular provision. Of course, the good part is that the government has not just written non-fungible tokens, because if that would have been there, it would have been a very wide and a very confusing statement.
Right.
They have written the non-fungible tokens to be notified, because
Right.
NFTs can also be of different formats. They can have some tokens can bring access to digital products. Some tokens
Mm.
can bring access to physical products also. So it will have to be seen what particular non-fungible tokens are notified by the government for the purpose of Section 247A.
Okay, okay. And some two more, please, sir. One is from Advocate Ashok Kumar Sindha. He says, sir, who will deduct tax at source in case of virtual asset, stockbroker or anybody else?
So as I said, in the case, of course, the person. So the primary requirement is the person who is paying. Now,
Okay.
in case of, as I said, in case of platform models, uh, the a buyer may not know the identity of the seller, and
Right.
the buyer may not know the tax residence of the seller. What will be interesting is uh, how will the platforms deal with it, because in case of stocks, in case of listed shares and stocks, sometimes these provisions are not applicable, the TDS
Right.
provisions, because in that case it is already governed by a regulated system. So we'll
Okay.
have to see whether government brings out any guideline, any clarification as to, if the buyer does not know the identity of the seller, whether this provision will continue to apply or whether it will not apply.
Okay. Okay. And one more in-house query. Whether these gains would be taxed under the head capital gains or they would be taken under the other sources.
Let's see how the return form also comes. But
Okay.
so the interesting bit is they've not touched the definition of capital asset.
Correct.
But at the same time, the word transfer has been used, which is generally relevant for capital gains head. So let's see how the return forms come and where does this particular special rate item of 115 BBH goes.
Right. There's an ambiguity still on it.
I think, and I think during the passage of the bill, because in the past 2-3 days, a lot of discussion has
Right.
been going on. A lot of discussion, debate is going on. A lot of stakeholders are expressing their views. So I do expect that when the bill becomes an act, a lot more clarity is there.
Correct. Correct. So I think with this, we wrap up our session, and it was indeed a very insightful one. And I hope many juggling with this new taxation on VDAs will get their answers. So thank you
Mm.
so much, sir. It was a pleasure having you.
Thank you. Thanks a lot.